G'day guys, it's Ben Everingham and my brother Simon here from Pumped On Property, and in today's video we're going to talk about 8 of the holding costs associated with buying an investment property. So welcome to our channel. If it's the first time you're here, please subscribe. We produce a heap of really cool videos each week, and in today's video we're going to talk about the top 8 things that we think are important, like interest, like your normal property management stuff, but probably a few of those other things that you haven't really thought about. So Simon, why don't you kick us off with the first one, which is really this conversation around interest and the loan repayments associated with holding a property.
Perfect. So when you first purchase an investment property, most people, well, about 100% of people probably,
unless you've got heaps of cash, you have to get a bank loan.
Exactly. And to get a bank loan, those banks charge you interest on that loan to make it worthwhile for them to help you out and to get into the property market. So once you've got that loan, you need to repay the interest every single year. So depending on how much you borrow from the banks is going to depend on how much interest you need to repay.
Now, interest rates go up and down, as we all know. Right now, they're as of 2018 at historically low levels. So an interest rate of sort of 4 to 5, maybe even 6% is quite low. But interest rates in the past, if you talk to some of your parents who owned in the 80s, got up to ridiculously high rates in the early 90s. So just remember that, you know, your interest rates fluctuate. It's completely normal. Don't freak out about them going up a little bit. Don't freak out about them going down too much. In fact, who's going to freak out about saving some cash? But it is a cost associated, and probably the most expensive cost associated with holding a property. So the second thing which I think is important to check out is council rates. Now, this is just basically the council putting their pocket into the Australian industry for doing almost shit all. And whoops, I might be saying a bit too much there, but realistically putting their money into the pocket of every homeowner in Australia and raising money for their taxes and their jobs through your property. So, you know, you see on your council levy, your bins are in there, your recycling bins in there, your sewage and your water's in there. Some councils put a lot of that money straight back into the community, and that's where you see the beautiful paths, the beautiful parks and stuff like that, and the beautiful waterways. Other councils, most of those in Sydney, don't look like they're spending any of that money, and that's probably why their councillors are going to prison at the moment. So, you know, council rates are an inevitable part. Council rates basically depend on the value of your property effectively. The more expensive, the more your rates are. The cheaper, the lower your rates are. Different council areas are different. A rule of thumb might be somewhere between $400 and $1,000 a quarter type thing.
The next one, which may or may not be a factor of your investment property, is the water rate. So with older properties, generally you're going to have to spend a little bit more money on the water usage of that property. But if you have a newer property and it's actually considered water efficient, generally the tenant might actually have to pay for that water usage.
Yes, that's a really good point, because water rates are broken into 2 components. One is the admin charge, which now that the government's sold off all of the water assets is ridiculously high, about $250 to $300 a quarter. And then there's the usage rate, which, as Simon said, if you make your property water efficient, which you should, you can on-charge the water component back to your tenants, which I think is a cool little saving. Although the you know, where you're getting smashed on water rates has nothing really to do with the water usage anymore, unfortunately. So let's talk a little about insurance, Simon, and the 2 different components to it.
So everybody's required to get building insurance when they get an investment property, but what not all investors understand is they should be getting landlord insurance. And I was excited to talk about this one with you today because you've got a pretty funny story about landlord insurance, don't you?
So I luckily did have landlord insurance on a property of mine. Unfortunately, I didn't have the best tenant in the world in the property. So really long story short, my tenant actually burnt down my granny flat at my house, and then drove a couple of cars through the front of my house, and then completely trashed my house. So I'm lucky that, one, I did have my landlord insurance in place, which meant I got something like 10 weeks worth of rent paid out after they left. Luckily, I also had my building and contents insurance in place as well, and Allianz, who was my insurer, I'm not recommending anybody, but they were pretty good to deal with throughout that experience and actually gave me more than it was worth back. So yes, it was an absolute pain in my ass. You've just got to have a laugh about it all now. But building and contents insurance, as well as landlord insurance, is a must for anybody who wants to protect their asset.
Perfect. And the next one that I want to talk about, which is really hard to actually gauge how much you need to put aside for this, is the repairs and maintenance on a property. As a property gets older and older, obviously there's going to be repairs and maintenance issues that come up at different points in time. That might be the oven might break, the air conditioner might break, there might be structural issues that you need to take care of. And unfortunately, you can't necessarily budget for these things because you don't know when they're going to come up or how much it's going to cost when they do come up. But it's inevitable that at some point in time, these things are going to happen. So putting a little bit away each week is really important to make sure that you can cover those costs.
So let's say you've got an account associated with your investment property where the rent goes into the costs of that property go out. I like to just put on an older property about $1,000 a year away into that account to cover all of those unexpecteds, and you might not hear from the manager for 3 years and then all of a sudden there's $3,000 worth of stuff. If it's a brand new property, then obviously the maintenance costs associated with that property become much lower, and so depending on what your personal strategy is, I like brand new properties now or nicely renovated properties now, just because I've had so many maintenance issues on the 11 properties that I've done myself in the last 8 years. So just factor that into your budget, or don't, which is what 90% of people do, but don't get upset when you get a $5,000 bill because as Simon said, air conditioner, your oven, your stovetop and your water heater go out in 1 year, which has happened to me before.
So the sixth that's cost associated with holding an investment property that I wanted to talk about is property management. So when you get an investment property, it's recommended to get a property manager to look after that property to make sure that they're advertising your property on the appropriate networks, and also sourcing suitable tenants for that property and making sure that they're paying the rent on time every single week, and giving you regular updates as to what your property or how those tenants are treating your property and what sort of maintenance issues might be required.
Now, a good property manager is a whole series of other videos, but what we're talking about here is the costs. So the costs with the property manager are broken up into two things. One is the percentage of the weekly rent that you're paying. So let's say that you get $400 a week and your fee for your management is 7%. You're talking about 4 times 7, $28 per week type thing in management fees, and that's the ongoing fee for the management. The second part of the management fee is generally when you have to find a new tenant. They charge you either 1 or 2 weeks worth of rent to find that new tenant. That goes covering their time for doing that. It also covers the realestate.com advertising fee and whatever other channels they're paying for. So it's important to know that 1 to 2 weeks rent is pretty normal up front for a new tenant, and then somewhere, depending on the state, Melbourne and Sydney seem to be a lot cheaper. 4 to 5 or 6% down there is normal. Where up here in Brisbane and some of the other states, you're looking at somewhere between 7 and 10% for your management. So don't freak out if you're buying up here in Brizzy, which is epic at the moment. If you're living in Sydney and Melbourne, it is just a bit different. But also remember that because the rents up here are a little bit lower than Sydney and Melbourne, obviously these guys still need to make a living as well. And sometimes it's worthwhile paying a little bit more for a quality manager than going the cheapest in the market. Again, I've had 11 or 12 property managers in the last 8 years, and I've had some absolute shockers. So you pay for what you get in that space for sure.
Quality always pays for itself, we believe. So the last couple of things that I wanted to talk about, or we wanted to talk about, were the taxes that can be associated with investment properties.
So what we're talking about tax-wise there is land tax. Now, I'm not going to go into this too much, but you can just jump on Google and type land tax plus Queensland and understand what the thresholds are. Most people just getting started in their portfolio will be below a land tax threshold, but in the future, as the value of your property goes up, you might get a land tax bill, which is always so much fun. Again, that's more like the state government or Australian government's way of picking a little bit of the profit out of your portfolio, which they love to do. And the second one there, sorry, I'm looking at the bottom of the body, is the tax on the rental income. So let's say that your property is positively geared after all tax and all tax benefits associated with holding your property and all the costs. That actually, depending on how you've got it set up, and we're not going to talk about that because we're not accountants or financial planners, but you may end up having, if you own the property outright, to pay some tax associated with that because it goes back to your income. That's a conversation for your accountant and your financial advisor, but as my accountant says to me, paying tax isn't a bad thing, Ben, because it means you're making a bit of money. And I say, well, thanks for that. I got nothing to say, man. So they're sort of the 8 things that we thought are the holding costs associated with an investment property. Just to recap, we're talking about loan repayments or interest, council rates, water rates, insurances, repairs and maintenance, and those management fees, as well as taxes associated with the property. So, treat your property portfolio like a business. Running a good business is about keeping your costs as low as possible, keeping your quality of your product as high as possible, attracting quality tenants. And if you do all of those things and have the right insurances in place, and you buy in the right markets, your Sydneys, your Melbournes, your Brisbane, that have historically done very well according to core logic, then long term you should get a benefit from holding a property over a 15 or 20 year period, and hopefully end up in a much better position than you are, even though it can be a little bit expensive to actually hold the property in the short term until that rent increases. So thanks for your time and your attention. Have a great day and keep checking us out. Thank you.
Bye.